Welcome to the Forex Trading Channel, where you learn to trade like institutional players. Trading mindset in financial markets. When entering financial markets, many people believe trading is simply about finding a good indicator, following buy or sell signals, and making profits. But in reality, it is far more complex than that. The market is a highly competitive environment where large players such as hedge funds, banks, and institutional investors constantly search for advantages. To survive and grow in this environment, we must develop the right trading mindset. 1. Understanding the large players. First, we need to understand that the market is not dominated by retail traders. A significant portion of market liquidity comes from institutions such as banks, hedge funds, and professional traders. These large players control massive capital and can influence market movements. Their trades are not random. Every decision is based on strategy, planning, and clear objectives. Therefore, instead of trying to predict where the market will go, we should learn how to observe and follow the footprints of institutional money. When we understand how large players operate, we gain a major advantage in trading. 2. Analyzing market data. A trader should never rely solely on emotions. Decisions must be based on data. Market analysis involves using both technical and fundamental tools to understand price trends. Price charts, technical indicators, trading volume, and economic factors all provide valuable information. By analyzing market data systematically, traders begin to recognize patterns and repeated behaviors in the market. This helps us determine whether the market is gaining strength, weakening, or consolidating before a major move. 3. Monitoring market psychology. Financial markets are not just numbers. They are driven by human psychology. When prices rise sharply, many traders feel excitement and FOMO. When markets fall, fear spreads quickly. Large players understand these emotions very well and sometimes take advantage of them. They may create liquidity sweeps or sudden moves that trigger stop losses or cause retail traders to react emotionally. Therefore, a skilled trader does not only read price charts but also understands the psychology behind market movements. 4. Understanding market structure. One of the most essential skills in trading is understanding market structure. Price movements are not random. They often follow patterns such as higher high and higher low in an uptrend, lower high and lower low in a downtrend. There are also phases of accumulation and distribution. When traders understand market structure, it becomes easier to identify whether a trend is continuing or potentially reversing. 5. Analyzing liquidity and order flow. One of the most important principles in trading is the market does not move because of indicators. It moves because of liquidity. Large institutions need liquidity to enter and exit their large positions. As a result, price often moves toward areas where many orders, stop losses, or liquidity pools exist. By understanding where liquidity is located, traders can better anticipate major market movements. Tools such as volume profile, order flow, footprint charts, or bookmap are commonly used to observe these flows of liquidity. 6. Identifying entry points. Knowing the trend alone is not enough. Traders must also know when and where to enter a trade. One important rule is to avoid chasing price. Instead, traders should wait for confirmations such as a retest after a structural breakout reactions at liquidity zones, confirmation from trading volume. High-quality entries often appear when price revisits an important level. 7. Risk and capital management. Many traders lose money not because they predict the market incorrectly, but because they fail to manage risk. One of the core principles of trading is capital protection. This includes setting appropriate stop-loss levels, avoiding excessive risk on a single trade, maintaining a favorable risk-to-reward ratio. Proper risk management allows traders to survive and remain in the market long-term. 8. Discipline and trading psychology. Finally, the most important quality of a successful trader is discipline. The market constantly presents temptations: FOMO, overtrading, or revenge trading after a loss. Professional traders understand that losses are part of the game. What truly matters is following a trading plan and maintaining discipline. Conclusion. Trading is not gambling. It is a process of learning and developing the right mindset. When we understand institutional players, analyze market data, read market psychology, understand price structure, follow liquidity and order flow, enter trades with a plan, manage risk properly, and maintain discipline, we are no longer trading blindly. Instead, we trade with a clear and structured mindset. At that point, we are no longer trying to beat the market. We are simply moving with the flow of money. Swim with the sharks, never against the liquidity. I will take an example to illustrate this. As we can see in this image, when price returns to the key strike zone, the market starts to show a clear reaction. Looking more closely, liquidity is continuously being added in this area. This raises a very important question. Is this large players defending their positions, or is it simply a liquidity zone created to facilitate order execution? We can observe that iceberg orders are being triggered repeatedly in the upper area. However, price continues to decline afterward, and more icebergs keep getting triggered. So, the key question becomes, are the sharks, large players, actually trying to defend their positions in this area? If we look further, we can see that price is located near a low-volume node, while the CVD is rising strongly. If the objective of the large players is to defend their long positions, they would typically absorb the selling pressure and push the price upward right at this key strike zone, rather than allowing the price to continue sliding downward. In another example, price returns to the key strike zone, which also coincides with a low-volume node. On the first touch, price immediately reacts and moves upward. When the market comes back to test this area again, stronger buying pressure appears and quickly pushes the price higher. What is particularly notable is that the CVD rises sharply at that moment, indicating that aggressive buyers are absorbing the available supply and defending this area. In the final example, when price reaches the key strike zone, we can observe that the upward momentum begins to slow down. At the same time, iceberg orders are continuously being placed into the market. In addition, spoofing pressure zones keep shifting downward, creating pressure that pushes the price lower. From these signals, we can clearly see the intention of the large players. They are creating selling pressure to force the price downward. Additionally, if you want to better understand how the key strike zone works in the market, you can join the Level 3 membership, where I explain the concept in much more detail. If you are not a member yet, you can still follow the daily updates on my channel. Currently, I mainly provide daily analysis for gold. However, if you want to learn how to identify key strike zones for markets like NQ or ES, you should watch this video, where I explain the process in detail. Thank you all for watching. If you found this video helpful, hit the like button, subscribe to the channel, and turn on notifications for more order flow analysis.